Is Citi forecasting that the precious commodity could have even more room to run, predicting that gold could hit 3,000 in the next couple of months. To break down his call for us, we have Aakash Doshi, Citi North America Head of Commodities Research. And thank you so much for being here with us this morning to talk about gold. This morning in our meeting, we were talking about folks running a Costco to buy gold bars versus folks who are investing in it via the market here. I'm curious from your perspective, what should investors know about the difference between those two and the room that gold has to run in this rally moving forward?
Well, it's great to be back with Yahoo Finance. I remember in the summer of 2019, I was in your studios calling for $2,000 an ounce as a base case over the next 12 months at the time. Now we think $3,000 an ounce is in play over the next year or so. And the big driver for that is that we think financial demand for gold is only catching up to what is strong physical. You just talked about the Costco bar and coin sales. Well, that is a global trend. We've seen bar and coin demand surge since the pandemic. It's now above pre-COVID trend. And that, we think, represents a strong alternative fiat demand story. Separately, we see the official sector, central banks in the emerging markets to be, in particular, to buy a record amount of gold over the last several years, including over 1,000 tons in 2024, which would be the third highest since 1967. We think this physical demand pull is structural, it is strong, it is driven by a host of factors, and financial demand for gold is only catching up to that. I mean, if you look at the gold price performance since the February lows, we're up around 20%. It hasn't been a weaker dollar. The dollar is higher. It hasn't been lower real or nominal rates at the belly of the U.S. Treasury curve. Those are at year-to-date highs. So we think the risk skew right now is still bullish for gold in the medium term as financial macro factors will catch up to what has been strong physical that has supported the gold market over the past year.
When we're talking about the biggest driver, I think that's really up for debate when people are trying to figure out how high the price of gold can go. Is it the central bank buying, or is it some of those macro factors that you were just talking about?
I think over the last couple of years, it has been central bank buying that has at least done two things. It's lifted the gold price floor, and it's also damped downside price volatility. If I was in your studios a couple of years ago and I told you that the Fed was going to hike to 5.25 to 5.50%, that real yields at the belly of the US curve were going to go from negative territory to plus 200 basis points, I don't think many people would have thought that gold is going to kind of average 18 to 1900 over those last couple of years and then break out to all-time nominal highs in 2024. So we do think the central bank demand story is important because they're now absorbing 25 to 27% of annual gold mine production. And like I said, the alternative fiat demand story also seems to be gaining legs and gaining traction. If I look at global debt loads outstanding, public and private, since the pandemic from 2020 to 2023, that grew 20 to 25% to 315 trillion. I think at some point it just was a breaking mark for gold investors and gold bugs. And to that end, we think that kind of post-financial crisis where you saw $1,000 an ounce turn from a gold price ceiling to a gold price floor, that we might now be in a period where $1,900 to $2,000 an ounce gold is actually kind of a support base, and that prices are now going to trade higher for longer above that benchmark.
Well, I'm curious, I know that part of your note here indicates a 40% upward revision to your 2025 target. Given the growth that you see for this commodity, what does that tell us about what your anticipation is for what the Federal Reserve is going to do moving forward?
Well, that's a great question. I think the surprising thing is that this gold price spike that we've seen over the last 6 to 8 weeks has happened in the face of more hawkish Fed pricing. We've gone from 6 to 7 cut expectations at the beginning of this year down to 3 to 4 in February, and now we're at less than 2 following strong U.S. retail sales for March yesterday. I think from that standpoint, the risk reward is probably for higher gold because hawkish pricing is probably peaking out. We don't think that hikes are really on the table in this environment. We think the Fed wants to keep 10-year Treasury yields below 5% or at 5%, and that financial conditions are tight enough for the monetary policy authorities. So in that context, we do think that an eventual Fed cutting cycle will be a kicker as real yields could rally. Even if they do insurance cuts and nominal rates stay higher. To that end, also, I would note that if there is a U.S. recession, which is not priced by markets right now, that could also be a further kicker towards $3,000 an ounce gold over the next 6 to 12 months.
Gosh, Doshi, we really appreciate you taking the time to join us here this morning on the heels of your new note that's out. Citi North America, head of commodities research. Thanks so much for taking the time.